Welcome to the FarrCast, bringing you insights into Wall Street, Washington, and the world. And now here's your host, Michael Farr.
Welcome to the FarrCast. I am Michael Farr. Thanks so much for joining us again this week. It is the second day of May. Hooray, hooray, it's May. So there we go. We're all ready to go outside. That's a good thing. Thank you to my great friend and Professor Willie Koch from Sewanee, who always celebrated the first of May. Futures have been rough for the market, but futures are a little bit mixed this morning. Dow futures are up. That's a bit of a difference. S&P futures up, NASDAQ futures up. Everything's looking strong. We're happy post-Fed day for some reason that I don't understand, but everything's okay today. So we're going to try and figure out what markets are doing, what the Fed's saying here. Earnings season still seems to be relatively good. We're going to do a couple of things on the FarrCast today, but one with Mahaffee, we're going to try and tackle what's going on college campuses and why, what's going on in Palestine. I've been to Palestine, been to Israel. We're going to talk about that in our segment 2. And we're going to cover a little bit more of the international too in our segment 3. But first, we get to start with our great friend Jim Iuorio from TJM Institutional Services, the voice and face of the Chicago Exchange, and the guy who explains the world of trading and volatility and everything else to us. Welcome back, Jim.
Thank you for having me, Michael.
We're really glad you're with us. Jim, markets had a really rough April. Things went down. Was that the correction we've all been waiting for? I'm beginning to think it is, because everybody's saying, "Oh no, that's not it. There's a lot more to go," which is usually what they say when it's over.
I agree. I think there's about a 40% chance that was it. What did it get to? Like 6.7%. I had originally thought 10% was a minimum that I needed. But something happened yesterday that I'm not saying it's changed my thesis yet, but it's certainly worth some additional calculation. And that's, we heard from Jay Powell yesterday, and he talked about how hawkish he was going to be. He pointed his fingers. He slammed on the table saying, we're fighting inflation. But watch what he did versus what he said. He also reduced the size of the bond runoff from $35 billion a month to $25 billion a month. That is a de facto easing. It's not a quarter point ease. It's probably much, much less than that, but it's about this tiny bit much of an ease. And then markets kind of turned around on that. And this morning, the stocks are up. Gold turned around on it. Silver turned around on it. Copper's been marching to its own drum. But I think what the market is saying is that despite what he says, he has some things that he's worried about. And one of the things he's worried about is bond auctions, making sure the Treasury can sell their bonds. And if he's selling, or essentially synthetically selling $35 billion a month of bonds, then the Treasury might have a difficult time. So he's worried about the macroeconomic condition a little more than he lets on. Does that make any sense?
Yeah, it makes sense. And I think we have to stop and explain exactly what this means, because it is a bit wonky. But basically, he came out with a more hawkish message because we were scripting this big easing and 7 eases this year. And now he's saying, maybe we're not going to take it off the table. But everything I'm seeing, Jim says, there is no ease coming. I don't see any ease unless it's a political ease. I don't see any ease based on the economic data in the next 6 months. I mean, that would be argued. I think the Fed needs to sit there and watch and see if this tick in inflation actually goes back down. But there's no indication that it's going back down. You saw the unemployment numbers.
No, but what I'm saying, they're not. I agree that they're probably not going to officially ease in 2024. But by his actions yesterday, it just showed a little bit of a glimpse that he's a little more willing than we think he should be. And I agree with you. You know what I mean? He and again, there's many analysts who say that once June passes, once we get into July, any ease at that point in time, the optic of it is going to be terrible, and it's going to look largely political. And by the way, as we talked about in the green room before the show, I understand that if one of the candidates says he's going to fire you on day one, whether it's consciously or subconsciously, I have no problem with that person wanting a different person to win. I know it's not his job. I mean, I can understand it. So if he wants to keep rates low, to have the optic, to have things looking good into the election, whether he knows it or not, I believe that's on the table. Thoughts?
I think subconsciously, consciously, as you said, Jay Powell knows that Donald Trump is saying he's going to fire him and he's going to take over more control of the Fed. So it's certainly in Jay Powell's personal interest to keep Joe Biden in office if President Trump takes that tactic. Now, knowing Jay Powell, that will be very unconscious if he does it. I mean, this guy is a real kind of Boy Scout guy. He really is. Doesn't suggest you should mess with him, because you shouldn't. He's pretty determined. But Jay, he won't know he's doing it if he's doing it, but it's got to be in the back of his mind somewhere. What I saw yesterday was a bit of a balancing act. If you think of those scales of justice, he pushed harder on the tightening scale, on the higher for longer scale, and he gave back a little bit, as you say, on the portfolio side. So ladies and gentlemen, the Federal Reserve has this huge portfolio. It's gotten up to $8 trillion, almost $9 trillion, and they're trying to pare it down and get rid of it. It built up during the financial crisis. It built up during the pandemic, when the Fed went out and bought bonds to keep rates low. When the Fed's out there buying and you've got more buyers than sellers, that puts pressure on prices to keep them higher. And when bond prices are high, yields are low. Please, I hope I haven't lost you already, but basically, when they are building that portfolio up, know that interest rates are going down. And when they're selling that portfolio, interest rates typically go up. So that they've slowed that, as Jim points out, they were trying to let it run off in a way that it just really wouldn't affect markets. They're worried because right now we're having to fund, we've got to fund a whole lot of the government's operations and spending. We have to fund everything that the government does, plus another $1.5 trillion more or less that we don't have. And the service on the debt, the interest, principal payments on that debt are going to be more than the Defense Department budget next year. The debt is getting to be a real concern, and Jay Powell can't watch those interest rates go too high too fast. Is that?
Yeah.
Do you think
I think you nailed
it there? Huh?
Yeah, I think you nailed it in that explanation too. I think the Fed is concerned about all the government spending and doesn't want to be selling alongside the Treasury as much. So I think they're going to get out of that policy, and I think they're starting to do that now. I think it's a huge concern. This whole thing, that the predicament we are in with slowing growth and inflation that's not going away, is a government-funded government function. They spend money like drunken sailors. You just mentioned the debt service. They're accumulating additional $1 trillion of debt every 100 days right now. We've never experienced anything like that. Since 1920, there have been 53 countries that have gotten to a debt to GDP ratio that was 130%. 52 of those 53 defaulted in some way. The only one that didn't was Japan, and we've all seen what's happening there. They just extend and pretend, and they're in somewhat of an economic quagmire itself. We are in a very, very difficult spot. Jay Powell, I believe, acknowledged that yesterday, which, by the way, we're all investors here and we're all traders here. What does that mean for assets? I think that's ultimately good for assets. I don't think the correction in the stock market is over, but I think that's for some other reasons. But ultimately, if the Fed realizes that they need to start supporting the bond market again, that's very, very good for assets, and things will go higher. Gold, silver, Bitcoin. Eventually, they had to work out of some of their own problems too, and eventually stocks as well. But I want my 10% correction.
So we haven't had that 10% correction. I mean, you still think it's coming?
I do still think it's coming, but again, after yesterday, it made the percentage ratio a little different. Before, I was like positioned like 75% chance that we get a 10% correction. Now I think it's less. I think it's more like 60, because it showed that he's concerned about this, and he might he being Jay, might do something to stem the tide of any sort of asset slide. So I still think we have a 10% correction. But again, the real takeaway there is that 10%, 12%, whatever, I still think in a year, like my long-term portfolio is not being moved at all. I'm fine with it. I'm just talking about trading.
Yeah, technically, Jim, we saw the market really go down. We saw some lows made, and then and for a week there, we had little sort of rallies in the morning that traded off in the afternoon. It was a classic go lower pattern. And then we had that big one-day reversal where we bounced up and closed higher off of the lows, and that was it. And, we've talked about it on the FarrCast. Technically, do you think we're in that backing and filling and you won't be convinced until you actually see a higher high? Or what's it going to take for you to really determine what's new, what the new direction is? Because I don't know what the new direction in the market is yet. I'm kind of being patient saying it hasn't told me quite yet.
No, shoot. It's so there is a level. It's not this last week's weekly high. If we settle above it, I don't have it in front of me right now. I think it's about, I'll post it on Twitter after this interview, but I think it's about 5190 to 5200, a settlement above there in the S&P. So it's a settlement above last week's weekly high. And I think to settle this week. And then if we build on that starting on Monday, I think that'll mean that I'm wrong and I'll throw in the towel on 10% and just have to be happy with the 6.7%, which I think is what we traded off.
Gold took off there, and gold has suddenly moved. I mean, we were in the $1,800 on gold, and all of a sudden we're now at $2,300 on gold, and we got to over $2,400 on gold. Why, Jim? Jack Barugian suggested that maybe the bond market's concerned and the commodity markets are concerned that the Fed is losing control of the long end, that they won't be able to really control what happens in the long end there as this bond issuance continues to go on, was Jack's theory. So why do you think the big surge in gold? I mean, that's a big percentage move in gold.
Well, so. First of all, everything that Jack said that's my primary reason. I believe that the market is worried about the government spending, but there's another way to look at the gold thing as well. 3 years ago to 8 years ago, the range was, like you said, 1,700 to 2,000. Gold bounced around in it. What if just get your head around this for a second? My mind, gold didn't move at all. The dollars that gold are denominated in were reduced in value by 30% by adding to the M2 money supply, just injecting so much money in. Remember, the Fed injected an extra $6 trillion into the economy from summer of 2020 to summer of 2022. So to look at gold and now to say that the range is 23 to 2,300 to 2,500 is exactly consistent with a 30% lower dollar. You get what I'm saying?
Yes. Yep. But the timing, markets move faster than that. I mean, the numbers make sense. Markets move fast. I don't know. Yes, the math makes sense, but
and
the
then people
doesn't.
pile in, and then that exacerbates the move. And that's to Jack's point too. And again, I'm trying to find a secondary reason to bolster the argument. Yep. Jack's argument about the concern of government spending is primo on the list.
So between now and the year end, Jim, what do you think? And you always hear the sell in May and go away. I actually wrote a couple of weeks ago, I said, listen, this sell in May and go away just creates a lot of taxes, and it's never really worked all that well. It's just a lower return period. But given where we are, taking some profits off of some of these companies, normally you look later in the year, but it's been a really good beginning of the year. Rebalancing doesn't bother me at all. And retail clients don't want to reallocate anything to fixed income now. They want stocks, which tells me they really should make sure that they're sticking with their long-term plan and their discipline. What are you thinking about that?
I think that rebalancing is always a good idea when you've had a substantial move higher, and it should be rules-based. And again, I don't give advice unless I know the depth of your pockets, your risk tolerance. But for me, it's rules-based. If the stock market goes up 20% and my broad portfolio, the tax-deferred one, because I don't like taking tax. I don't like taking taxes on these things. So the tax-deferred one, I will rebalance. Now, the notion that people don't want to be in bonds, I think this could be a generational opportunity to get 2-year money at 5.01%. This is, to me, it's staggering. By the way, this is kind of funny thing. I've traded bond futures for 35 years. It was a year and a half ago, and someone's like, well, you should buy bonds. I'm like, oh, how do I actually buy bonds, like real bonds? But I figured it out. It took about 10 minutes, but I'd never bought a bond before, because considering the whole time of my life I've had money, the last 20 years, bonds gave you nothing. Now bonds give you something. There's no such thing as like this money dry powder on the sideline equation that we used to talk about, because it used to be that money was sitting in 0%. Now that money is sitting in 5%. It's not dead money on the sidelines any longer. It belongs in a portfolio.
Well, if you say that the long-term return of the stock market, which old guys still say is around 7.5%, Young people want to tell you it's 11%. It's not.
Right.
It's not.
Yeah.
It's just you think it's 11% because you've had such short experience. Anyway, there are plenty of people on Wall Street were in diapers when Jim and I were starting in this business. Hell, when I started Farr Miller in Washington 27, 28 years ago, I mean, think of those new people on Wall Street. That was just starting the new company after getting in the business 6
and they
years
never
before
knew
that.
they never knew what money costing something. They knew free money. You know what I mean? Now is the first time they've had a cost of money to deal with.
And it's something that you have to think about because all you can expect of someone is to go from their sort of broad base, as broad as an experience base as they've got, and they just don't have it. And we sound like fogies when we talk about it, but we know when it changes, we've seen it before, and they will be dealing with something completely new and different that they haven't done the math on yet. So we'll watch that. Jim, at the beginning of the year, folks thought that the market could still do reasonably well this year. We've got to go here. You think we're still closing up 10, 15% on the year? We get through the election, all this other nonsense when this is all said and done?
I believe that. I think the 10 to 15% is reasonable for the year.
Yeah. Jim Iuorio is a partner director at TJM Institutional Services, the voice and face of the floor of the Chicago Exchange. Thank you, Jim, for being with us. We hope we'll see you again. We're going to come back, ladies and gentlemen, with Dan Mahaffee, and we're going to get into Palestine and Israel and everything else. Stay with us here on the FarrCast. Don't fight the Fed. You're not going to win that fight. Jim Iuorio is a partner at Cerity Partners, a CNBC contributor, and my wonderful friend. Good morning, Jim.
Michael, good morning. Hey, do you want to do the last part over? You said Jim Iuorio from Cerity Partners.
Jim would love to be a partner of yours.
I'd love to be Jim Iuorio.
No, he does. Jim's a pretty happy guy.
You tell me how you want to handle it. I'm fine. I can just
3, 2, 1.
Thank you for joining us this week on the FarrCast. Now it's time for political analyst Dan Mahaffee and your host, Michael Farr.
Welcome back. Joining me now, Dan Mahaffee, Vice Chairman of the Dr. Scholl Foundation, also from the Center for the Study of the Presidency and Congress, Washington, D.C. think tank, and the senior political analyst on the FarrCast. Welcome back, Dan.
Thank you, Michael. Great to be talking with you as always.
We're very happy you are here. So, Dan, let's start a little bit where we were wrong. Mike Johnson still got a job, and Marjorie Taylor Greene says she's going to call a vote next week. Tell us what's going on there. You and I thought that he might be out and that the Democrats had let him fall.
Yes, look, the Democrats have now banded together saying they will table Marjorie Taylor Greene's resolution on this, even as she pushes forward. They say they will table this. They're not going to pull the rug out from under Johnson. I think part of that is what they are concerned with, what they still need to get done for the year, the few things that remain. They don't want to shut down the chamber, even though they would like to have this chaos that they could blame on Republicans and their infighting. That said, though, this is going to continue to be in the headlines. Marjorie Taylor Greene is certainly not going to be shy about this. And the one murmurs we're going to see in the headlines, probably discussions from rank and file Democrats, is, okay, what are we getting from the speaker in return? What is the quid pro quo? Was it simply getting this Ukraine bill passed and now all is fair square? Or are they going to be a little incensed that Republicans have seized on the campus protests to force some votes that, frankly, swing Democrats are concerned about?
Yeah. Okay. So it seems like Washington, I'm being very optimistic here, but it seems like Washington's back to bipartisan governing, or at least for the past month. And Marjorie Taylor Greene doesn't like this bipartisan.
A mildly less dysfunctional version right now.
Okay.
Mildly less dysfunctional.
All right. Dan, we're watching these protests this morning at UCLA on the campus where the police are clearing the square there. And there are pro-Palestinian protests across college campuses in the country. I read an article on Market Watch, terrific article, explaining how there have been real economic consequences from these protests on college campuses. Going back into the 1960s, Ronald Reagan used the protests against the Vietnam War to help him get elected and say, I will clean that mess up on the UCLA campus. And he gained political positioning by doing that. The other thing is there is a suggestion, J.D. Vance has come out with a proposal to place a significant tax, 35% on endowments above $10 billion. And he cited the protests as a reason to enact his proposal. Democratic lawmakers have also proposed raising taxes on endowments as a way to encourage schools to ban legacy admissions, other practices that disadvantage low-income students. So the politicians all of a sudden see this disruption as a way to go in and get a hold of the money. Folks, always look for the money. Always look for the money. And the universities now in this country have huge endowments. Harvard and Yale, and people tell me, they're mad at Harvard and everything else. Okay, you're mad at Harvard and you're not going to send them your $1,000, $10,000, $100,000, $1 million. You think Harvard cares? Harvard's got billions of dollars in their endowment. You're not going to make a difference. A $1 billion endowment that's up 10% in the past 9 months, which almost all of them are, is up $100 million. It's up $100 million in 9 months. You think, they have so much power and control with that money that makes them bulletproof. Well, you're bulletproof until the politicians decide you're not. Dan, let's just start right there. This is a hot political issue. Will they actually go after the universities? Will J.D. Vance get traction?
I don't think there will be enough votes for J.D. Vance's proposal to go forward, but universities are going to have their time in the bucket. Historically, yes, you cite Reagan, 1968. Republicans are certainly hoping these protests continuing through the summer into the Democratic National Convention, they're salivating for that split screen that you could put up along with 1968 and the message that they could deliver about law and order and things like that, the unrest on campuses. On the other hand, historically too, you can go back to the, I think, 9th and 10th centuries, and you have the kings of England and France complaining about what the students are doing at Oxford and the Sorbonne, respectively. So politicians have always been perturbed with what's going on at universities in Western history. What we are seeing, though, is the students really focusing, and as you rightly point out, follow the money. These student protests, while largely focused on U.S. policy, really focus on their university investment policies and messages of divestment that harken back to the South Africa divestment protests of history, too. So there is very much a financial element. And I'll finally add, we've had a very interesting example nearby me with Northwestern University, where you haven't had that kind of police action. You've actually had a peaceful resolution because the university, believe it or not, just said, among a few other things, they're going to let the students meet with the investment committee. So, hard radicals who want to sit down and go over the balance sheets it tells you the kind of angle that some of these students are taking.
Well, we'll see if they actually show up to those meetings. But when I told you that $1 billion would be up $100 million, Harvard has $49.5 billion, Yale $40 billion, Princeton $34 billion, University of Pennsylvania $20 billion. The poor folks in the House, Johns Hopkins $10 billion, Emory $10 billion, Cornell $10 billion. University of Texas, $44 billion. Texas A&M, $19 billion. University of Michigan, $17 billion. University of Virginia.
We also know, with all due respect to the senator
billion,
and others, we all know how this would really work, that if you put in a cap, say at $10 billion or whatever, how many universities would then have a series of foundations capped at $9.9 billion?
You can spread it around and you'd absolutely be able to do that. Dan, let's talk about this Palestinian issue if we can. So going back to October, when Hamas invaded and surprised Israel, caught them off guard, killed How many people?
Thousands, 1,200 at least or more, if not more.
Yes. Women, children,
Civilians plus
everybody.
military,
It was a slaughter initiated by Hamas from Palestine. So Palestine goes, Hamas goes back into Palestine. Palestine is a desperately impoverished country. I've been to Palestine. It's sad. It's been this way for a long, long time. And there are residents, millions of residents of Palestine caught up in this war. And to see the people who were killed in Israel and the innocents who are being killed in Palestine is a tragedy. It's a human tragedy, and everybody should be upset about it, and it breaks your heart. Now, to say you're siding with Palestine when you really mean you can side with the Palestinian people who are being caught in this war, but to say that you are going to then become anti-Israel and become pro-Hamas, that calls for the annihilation of Israel and the Jewish people, is a step too far that doesn't make any sense to me. Dan, what am I missing in my understanding of this conflict? Not least, I suppose I haven't mentioned the funding from Iran and other places, and that Iran has fired on Israel directly. I'm really kind of concerned here that we understand this.
Well, yes, Michael, what we have is the continuing failure of these two sides to reach peace that goes back to the founding of the Jewish state, Israel, the partition under the UN, and the repeated wars and failed peace talks. The best we've had, of course, was Rabin, and then the opportunities with Barak and Arafat in the late 2000s. But Israel has largely pushed to separate Palestine. There's fundamental demographic and political issues at stake in terms of the identity of that area and the fact that the populations are changing there, the competition for resources, all of that has this in a very precarious geopolitical situation alongside millennia-long religious tensions. So it's the worst recipe possible when you think about it. And what we have now is an ongoing conflict where the Israeli political paradigm of destroying Hamas after an attack that was truly horrific and shattered the perception of security of that state, along with the ongoing attacks that have been foiled by Iran and others, has Israel feeling under siege at a time, though, when its political leadership is also at its most precarious and reliant on a very toxic political coalition of right-wingers. All of that makes it very hard for the United States to influence this course, even though we consider Israel one of our closest allies. And we even see Secretary Blinken there today visiting the humanitarian crossing into Gaza, saying this is good, but not nearly enough.
What are the college students missing in their protest? Because so many of them seem rather uninformed to me about exactly what they're protesting.
What I would say to the students
when they're chanting from the river to the sea, do they understand what they're saying?
I don't, and I think what'll be interesting to see is a law firm, Greenberg Traurig, the National Jewish Advocacy Center, Schoen law firm, others. They're actually now suing American Muslims for Palestine and National Students for Justice in Palestine, saying that these groups actually have links to Hamas leadership. What I would say to these students is, foremost, people of all sides and all faiths have been suffering under leaders who don't know how to come to the table for peace and only know conflict and self-preservation.
I think that's an excellent, really excellent point. They know self-preservation first and foremost. How about, Dan, from the river to the sea? Would you explain what that means?
Well, the idea that there should be from the Jordan River to the Mediterranean Sea, that you would wipe away the state of Israel. That's a part of, again, the Hamas charter is the destruction.
And all the Jewish infidels.
Yes, again, the religious element of this war, you have the irony of seeing a rainbow flag flying at a protest in favor of Hamas, given their policies to the LGBTQ.
What are the policies to the LGBT?
Oh, they would execute them.
They would execute LGBTQ. Yeah, they would execute them. So what we have here largely is ignorance, right? What we have here is ignorance of folks who might have wonderful hearts, truly wonderful hearts, to say, I hate the suffering that I see with these poor Palestinian, impoverished Palestinian people who are dying and don't have water and don't have houses and everything else. I hate that. But
And
when
frankly,
they start
Michael,
to chant from the river to the sea, and they want the removal and basically another type of Holocaust of all of the Jewish people, I don't think they know that. I don't think that the LGBT folks know that Hamas believes they should be killed. I don't. So it's ignorance. And isn't it interesting that this particular form of ignorance is dwelling on the biggest university campuses in this country? I mean, if you could just educate and say and explain, here are just the facts. Do what we do on the FarrCast. Here are the facts. How hard is it, Dan?
I think that's become very hard on universities, where a lot of the debate and discussion is now driven through political channels rather than that.
What has been very hard on the universities to educate the students with information?
Because you look at the sense in academia of how these things are being taught, the way that academia has long approached these issues has long been slewed towards a sense now of social justice. Others would decry it, use the term pejoratively, woke. These campuses have not been able to talk about many of these issues or educate them in a sound way in some time. And what we see now is a external event stressing all those things in terms of students' access to information, a lot of it social media and disinformation, administration hidebound by some of their own policies or the politics of their approach to campus and social justice protests, ideas that they've long promulgated along the ideas of certain groups being oppressors versus the marginalized. All of this pervades campus ideology rather than the pursuit of the truth at many of these institutions. Now, look, there are others. I don't want to, like members of Congress, let us not paint all with the same brush. There are plenty of universities that still do quality work and quality work in some of their departments, but other ones have seen this shift in academia towards in rewriting of history rather than understanding of it.
For those who are suffering in this war zone in this time, as it does for those in the Ukraine who are suffering. True human suffering for war and conflict seems to be as much of the senseless suffering I've ever watched in my entire life. It's happening again, and somehow we're continued to committed to keep doing this nonsense, and it's horrible. If I thought there was a way to relieve the suffering by going out to protest on a college campus or any street corner anyway, if that would relieve the suffering, I would be there right now to relieve that suffering. But I'd want to know what I was talking about, and I'd want to know what I was supporting and who I was supporting, and I would not support for the mass deaths of any society ever, 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 and support that sort of radical violence ever. I am as anti-radical violence as it gets. We pray for them. We pray for peace. Ladies and gentlemen, we will be back with more FarrCast as we try and still understand and explain as best we can what's going on around the world. Know that there are economic impacts. We've talked about them. There are economic impacts. They will affect Wall Street. And if they have to start selling stocks because these students are able to say, go after all of these international companies that do business with Israel, that will affect markets too. I don't expect it to happen, but it can. Dan Mahaffee from the Dr. Scholl Foundation, Center for the Study of the Presidency, Congress, and the senior political analyst on the FarrCast. Thank you so much. We always learn so much, Dan.
Good to talk to you, Michael. Thank you.
Please stay with us. We're going to be right back.
Michael Farr and the FarrCast are proud to support Heroes, Inc. Heroes supports the spouses and children of law enforcement officers and firefighters who gave their lives in the line of duty to the greater Washington, D.C. community. Their singular goal is to honor the supreme sacrifice made by these individuals by caring for their families. Heroes' work begins within 24 hours of the tragic loss and continues indefinitely.
We invite you to learn more about HEROES' mission at heroes.org. We hope that you will consider supporting HEROES as they endeavor to honor those who protect us. That's heroes.org. HEROES, here for you, here for good. And now, back to the FarrCast and your host, Michael Farr.
We appreciate you listening into the FarrCast this week. And now to introduce this week's special guest, here's your host, Michael Farr.
Welcome back to the FarrCast. Joining me now, a FarrCast fan favorite. And, you know, we have fan favorites who are really likable. And then we have the fan favorites who are really smart. The next guy is both. Dr. J. Bryson is chief economist for Wells Fargo. And he used to work for the Fed, and he's a PhD economist. So he's really smart, and I assure you, he's really nice. We've known one another a long time. Welcome back, Jay. Thanks for being with us.
Well, thank you, Michael. Thank you for your for the compliments there. I appreciate that.
Absolutely heartfelt, and I promise dead on factual, ladies and gentlemen, dead on factual. Jay, we had Jay Powell come out yesterday, and I heard people say he sounded dovish, and I didn't think he sounded dovish when he said, I don't think we're going to need another hike. I didn't think that was dovish. Maybe reducing the runoff on the Fed's portfolio from $35 billion a month to $25 billion a month, that was a little dovish, but it seemed to me a balancing act that he's always trying to affect. Maybe he did. Stocks are moving up this morning, so maybe they thought it was dovish too. What did you think?
So I kind of agree with you, Michael. I don't think it was necessarily over hawkish. I don't think it was necessarily over dovish. It was use a term that you can appreciate. I think it was right down the middle of the fairway.
Yes.
Pretty much. And I guess, the market reaction that you're alluding to, perhaps it wasn't as the statement wasn't as hawkish as feared. Maybe Powell wasn't as hawkish as feared. A lot of it has to do with
I like that. I think that's a really good way to say it. Not as hawkish as feared. Given the hotter inflation data, people perhaps could have expected him to, maybe have gotten a little scared, right, Jay? Maybe said, whoa, damn, we didn't do enough because this stuff is still lasting and persistent and stubborn. Maybe we need to do more, but he didn't really say that.
No, he didn't say that. I mean, he left. He didn't take the possibility of another rate hike off the table, but he also said he thought it was, I'm going to quote him here, he thought that was unlikely that they would need another rate hike. So I think it's kind of unlikely as well. I mean, I think what's more likely here is the Fed could be on hold for even longer than people think. And there's been, as you know, there's been quite a reset of expectations this year.
Yes.
We came into the year with the market priced for 5 to 6 rate cuts this year. Right now we're at 1 to 2, right? So there's really been a reset there.
Yeah, and that's big, and I don't think we may not see the 1 to 2. Would you agree with that?
I agree with that. I would think that the risk, let's put it this way, I think the risk of 0 is higher than the risk of 2 at this point.
When I was speaking at University of Delaware with Pat Harker, and by the way, thank you, Jay. Jay's done that with me as well, speaking at the economic forecast at University of Delaware, and I hope we get you back to do that someday, Jay.
Sure.
Pat Harker, I looked over at him during the middle of this speech and I said, why do you all have to do anything? I mean, isn't doing something an admission that you've gotten it wrong? Why don't you just sit there, with your hands folded across your laps and say, we got it right? If they don't have to do anything over the next, 9 months through year end, wouldn't that be an indication that they actually got it right here in the end? The level is right?
So first of all, I don't know. I don't think the level is right. I think the level is restrictive at this point, putting restrictions on the economy. And so at the end, so we think about, when we talk about the Fed, we think about its target range being between 525 and 550. What really matters, and that's in nominal terms, what really matters for the real economy at the end of the day is the real Fed funds rate. That is that nominal rate minus inflation, because a rate of 5.5% of inflation is 0 is a lot different than a rate of 5.5% of inflation is 10%. So you always have to think in real terms here. And so the point here is, as we go through the year, if inflation continues to recede, and we'll see, but our expectation is that's probably what's going to happen. If the Fed doesn't do anything between now and the end of the year, then that real rate is going to go up, right? You keep nominal rates the same, inflation comes down, the real rate is going to go up. You're going to have a passive tightening of monetary policy as you kind of go through the year. So
if inflation continues to come down.
If inflation continues to come down. And
currently we're at around 2% or 2.25% on the real rate?
We're about 2, and it depends on what inflation rate you want to use. Okay. But our best guess is we're probably around 2.5%. And just to put that in the real rate, and just put that in perspective, we have not been at a 2.5% real rate since 2007.
You think the 2.5% is restrictive?
Yes, I do think it's restrictive, because what you want to also benchmark that against would be the so-called potential growth rate of the U.S. economy, what the economy can grow in real terms for a sustained period without generating inflation or deflation. Most people would say that's roughly around 2% right now. And so just as a rule of thumb, you want the real Fed funds rate to be kind of at or just a little bit below what you think that real rate is. And at 2.5%, I certainly don't think the real potential growth rate of the U.S. economy is 2.5%. I think it's lower than that. And so therefore, I would say that where we are right now in terms of the real rate, it is restrictive. And if inflation continues to come down, and a lot of leading indicators would suggest that's probably going to happen, then that real rate's going to continue to go up.
Is that 2% GDP growth sufficient? I mean, I hate to ask an economist how he feels, but does that make you feel good or feel bad? If an economist indeed can feel at all, do you have feelings about? I mean, it's the dismal science, for God's sake.
I have a lot of feelings, Michael. Maybe not about economics necessarily, but so all right. So let me ask you. So let me punt back a question to you. Okay, so you said 2%. Real GDP growth. Would you rather live in a country where real GDP is the amount of goods and services we can produce a year is growing 2% a year with 0% population or growth, or would you rather live in a country that has 3% growth with real GDP growth with 4% population growth? And I'll give you my answer. Okay, not to put you on the spot. In the first example, where we're growing 2% with 0 population growth, that means on average, each of us has 2% more goods and services each year. In the other one, where the economy is growing 3% in real terms with 4% population growth, each of us on average has 1% less goods and services, right? You got to think about it in terms of per capita. Sort of here. So is that 2% good or not? So in terms of per capita income growth and per capita wealth and et cetera, I mean, you have to look at it, in that sort of standpoint. The 3% economy is, I guess, quote, good, because over time it gives you more ability, you're a country, more ability to project economic, geopolitical, military power if your country is growing faster than other sorts of countries. But at the end of the day, I think what matters for most people is their well-being and the growth in their well-being. And that's why we look at per capita things on a per capita basis.
An excellent point, and thank you for answering it. Now I don't have to answer it, because I probably would have gotten it wrong. I would have opted for the population growth and the 3%. Only from my most basic economic lessons that growing demographics, typically nationally or around the world, that are growing have more successful economies, have growing economies, and those with stalled demographics and populations, no population growth, typically don't have much economic growth. Is that right or not, Jay?
Well, so yeah, I mean, so generally that's right. I mean, so we talk about that potential GDP growth rate. One of the big determinants of potential GDP growth is your labor force growth, right? Everything
Yes.
else equal,
That's what I meant.
the more workers you have to produce goods and services, the more goods and services you can produce. The big key thing is, so if you would talk to any economist and you say, what's the most important thing for economies? At the end of the day, it boils down to productivity growth. Because the more, if every
is AI
worker,
going to change the world by adding productivity growth by some new factor now?
yes, AI is a productivity game changer. Now, it's in its infancy. I wouldn't expect it to have a huge effect in terms of that potential GDP growth rate in the next, call it 2 to 3 years. If we're talking 5 to 10, I think it has a much, it's kind of like where the internet and the networking of computers was, let's call it in the late 80s, early 1990s. People were starting to experiment with it, but it hadn't really filtered into the economy until like the mid to late 90s. I think that's
Right.
where we were in terms of AI. Now, AI clearly has profound social and political implications as well, but it is a productivity game changer. It's another industrial revolution.
Okay, so I've got 3 questions. We're already over time. I can't believe we're already past time, Jay, but this is great and this is hugely helpful. So here are my next 3 questions that I want to get to. 1, you just got back from China. I want you to tell our listeners what you saw there and what your take on their economy is and what you think our interaction politically, economically with the Chinese is going to do. That's one question, about 4 in 1. And your GDP forecast number for 2024 and 2025. Those 3 things. You want to start with China?
Start with China. So, yeah, so I've been going to China now for 20 some years, and what the difference that I saw in China between my first trip and then my second trip, say 2 years later, I just saw an immense change over that period of time. The traffic was so much worse. There were so many more cranes going around, buildings and whatever. It was just, a huge acceleration, and I saw that for the next few years. Now, I haven't been to China since before COVID. This is my first trip since probably about 5 years or so. But what I noticed was the delta between the traffic in 2000, call it 18 and 19, and today wasn't much delta, right? The traffic didn't seem to be worse. I didn't see a lot of cranes and buildings, and of course I was only in Beijing, so it's hard to tell. But that anecdote fits with what we're seeing macroeconomically coming out of Japan. And then, if you're talking to people in China, they're going to give you the company line or the party line there. You really need to get outside of China and talk to somebody who's really knows about China outside of China. And so I was talking to an economist in Hong Kong who follows China, and her sense of China was kind of dovetails with mine, and that is, we mentioned Japan before. I think China's kind of turning into a Japan, in the sense that when you think about the Japanese economy, when its bubbles blew up 30 years ago, the Japanese economy never collapsed. It kind of stagnated.
Right.
And that's kind of where kind of China is right now. The demographics are awful. They look like Japan. There's a lot of debt in China. It's not government debt like it is in Japan. It's business sector debt, but there's a lot of debt there. And so I wouldn't expect the Chinese economy to collapse, but I think it's going to, roughly stagnate.
Okay, GDP 2024, GDP 2025.
This year, next year, we're looking for 2%. We don't have a recession in our forecast. I can think of how you get there, but it's not our base case.
So perhaps not as quick next year. And in spite of the last weaker print we had on GDP, you expect an acceleration somewhere in the 3rd and 4th quarters, yes?
Well, I don't want to get into how all the math works or something like that. But what I would essentially say is what we're looking for is essentially slower growth this year than last year. Last year was a very, very good year. This year, I think, because of the tightness of monetary policy right now, you'll continue to see growth rates roughly on the order of what we saw in the first quarter. And let's call it, 1.5% to 2%.
That's a very manageable environment for investors to navigate. I mean, historically, interest rates still staying low from Dr. Bryson, and indeed they should come down in order to keep that real rate consistent and not overly restrictive, I think is what we've heard. And overall, the economy will continue to expand at a historical rate. Have I got it, Jay?
Yeah, I would say that I would nuance it a little bit. I would think that the economy is probably going to grow a little bit slower this year than its potential growth rate of roughly 2%. I'm going to take the under in terms of essentially where we are there. And I think interest rates are going to remain restrictive for a while. I mean, what that means for stock investors, I'm not a stock market strategist. I don't know about valuations or things of that nature. It's not a disaster, right? But I don't think in terms of the economic backdrop, but I don't think it's party like it's 1999 literally either. In terms of GDP growth here.
For those of you who were not in the market, I assure you that was a party in 1999, big time.
You're dating yourself now, Michael.
Oh, I can do
even worse. You can do worse than that.
Yeah. I can do worse than that. And hell, you were there. So
I know.
We'll go. Let us go then, you and I, where the stars spread out against the sky. All right. Dr. Jay Bryson is chief economist for Wells Fargo. My very dear friend. Thank you, Jay, for being with us.
My pleasure, Michael. Always a pleasure to be with you. Thank you.
Always a pleasure. Ladies and gentlemen, that's it for another FarrCast as we cover Wall Street, Washington, and the world, bringing you experts and insiders so that we can better understand what's going on in the world around us and make sense of it for our economy, for our country, and for our portfolios. We hope it's helped. I've learned a lot this week. We'll see you next week. On behalf of my producer, Harry Jennings, everybody at Hightower, and Farr Miller in Washington, thanks for being with us. We'll see you next week. I'm Michael Farr.
Thanks for being with us on this week's episode of the FarrCast. We hope you enjoy the show as much as we enjoy making it for you. And thanks to our guests, Jim Iuorio, Dan Mahaffee, and special guest, Dr. Jay Bryson. FarrCast is produced by Michael Farr and Harry Jennings and comes to you weekly for free on all major podcast platforms, including Spotify, TuneIn, and Apple Podcasts. Please be aware that anytime we or any of our guests mention a specific company, sector, or refer to performance in relation to an earnings report and use headline or economic trend, it is not a recommendation to buy or sell. Please review the risks and rewards of any investment with your financial advisor for what specific investment and general strategy is appropriate for you before you make any investment decision. And as always, if we can be of assistance at Farr Miller in Washington, please reach out to me at hjennings@farrmiller.com. We are here to help, and I'm happy to arrange for any of our listeners an appointment with one of our financial professionals to review your portfolio, your needs, and your goals. We'll be back with you next week. Take care, stay safe, stay healthy. Thanks for listening to the FarrCast. Wall Street, Washington, and the world. Farr Miller in Washington is a group comprised of investment professionals registered with Hightower Advisors, LLC, an SEC-registered investment advisor. Some investment professionals may also be registered with Hightower Securities, LLC, member FINRA and SIPC. Advisory services are offered through Hightower Advisors, LLC. Securities are offered through Hightower Securities, LLC. All information referenced herein is from sources believed to be reliable. Farr Miller in Washington and Hightower Advisors, LLC have not independently verified the accuracy or completeness of the information contained in this podcast. Farr Miller in Washington and Hightower Advisors, LLC, and any of its affiliates make no representations or warranties, expressed or implied, as to the accuracy or completeness of the information or for statements or errors or omissions or results obtained from the use of this information. Farr Miller in Washington and Hightower Advisors, LLC, and any of its affiliates assume no liability for any action made or taken in reliance on or relating in any way to the information. This podcast and the materials contained herein were created for informational purposes only. The opinions expressed are solely those of the authors and do not represent those of Hightower Advisors, LLC, or any of its affiliates. Farr Miller in Washington and Hightower Advisors, LLC, or any of its affiliates do not provide tax or legal advice.
This material was not intended or written to be used or presented in any way to any entity as tax or legal advice. Clients are urged to consult their tax and/or legal advisors for related questions.